Welcome to the Lifestyle Property Podcast. I'm Jamie Greaves, your host and professional property investor. I'm here to bring you insights, home truths and powerful stories about what really goes on in property investment, business and growing your dream lifestyle. Are you ready? Let's get into it. Hello and welcome back to Lifestyle Property, and welcome to episode 12 titled Become the Bank. And today I'll be teaching you how to become a bank. Real life Monopoly here. And this is the natural progression of a property investor and how to create ultimate lifestyle freedom and how to fuel your mission in life. Okay, so last week we covered a core model, which was the relationship between time, capital and knowledge. And then this is another core one, which is becoming the bank. And really there are 5 steps, and there are 5 steps of evolution. Okay, and I'm going to mention these all now, and then I'll do a deep dive for you. Okay, so step number 1 of becoming the bank, and I'll explain why we will want to do this later on. Step number 1 is financial understanding and eliminate bad debt. Number 2 is building cash flow. So you've got to build your cash flow. Number 3 is making great capital, and these are in order. Okay, so if you make a note of these, it's 1, 2, 3, 4, 5. 4 is securing slower assets. Okay. And 5 is becoming the bank. Okay. Now, some people can skip levels because they've already mastered the previous level. So some people can skip right to becoming the bank, which is something that I'll talk about at the end of the podcast and on next week's podcast. But if you're going full time in property, this is the game plan to follow. 1, 2, 3, 4, 5. Financial understanding, building your cash flow, making great capital, securing slower assets, and becoming the bank. So I'm going to deep dive these for you now, because this was an incredibly useful model for me to understand some years ago, and I've applied it and it's worked amazingly well. So this is one definitely to follow. Okay, step number 1 is getting a really good financial understanding. So before we can get financial freedom and become the bank and all these amazing things, we need to have a really good financial understanding, okay? So what do I mean by that is, so hopefully you're not in any personal debt, okay? But if you are in any personal debt, what's best to do is pay off and get rid of the most expensive debt, okay? We don't want bad debt. Okay, so the most expensive debt would be if you've got 2 forms of interest, 2 bad debts, and one's 10%, one's 20%, pay off the 20%. Okay, so to get rid of our bad debt and learn about good and bad debt. Okay, and this is something that I'll perhaps cover on a different podcast or a different time. But good debt is things that will produce you an income, and investment property is really good debt. Okay, bad debt is a depreciating asset like a car or a holiday. Okay, you earn assets and pay for your luxuries that way. Okay, and if you can, you want to get a great credit report in terms of financial understanding. Get a good credit report, eliminate any bad debts, and get into the habit of earning more than you spend. I found it very, very funny. I've got some Asian business partners, and they see me as having Asian tendencies. So there's certain cultures in the UK and globally where we earn more than what we spend. It's a very Yorkshire thing, I'm told, because that's what I've always done. And I've been informed by my Asian business partners that a lot of the communities, a lot of their communities like that as well. But it's not taught in schools, and it's not taught to wider society, is it? Okay, so let's get the habit of earning more than what we spend. Okay, so that's baseline. Make sure we cover this first. Okay, so if you are there, that's where to start and go through the level. So as I'm teaching you this model today or tonight, whenever you're listening to this, go through the models of where you're at, and this is the order. So the reason for me doing the podcast is to reduce overwhelm, bring clarity, reduce all the frustration and loss people go through. So this model's cornerstone to that. So step number 2. So once you've got a good financial understanding, is building your cash flow. Okay, and this is the only place to start. Just to explain a little bit further in terms of why this is the only place to start is, so in terms of becoming the bank, step 1 in terms of financial understanding, we're not yet investing yet. So if you're in loads of credit card debt or personal debt, let's sort that out. Let's get that paid back and just get your head above water so you can breathe, so you can think, because you want to get all that bad debt sorted and get a good baseline of financial understanding from podcasts like this and elsewhere. And then once you are ready to invest, this is why we then say, right, then we start. Then we go into step 2, which is cash flow. Okay, and the investment career of a full-time property investor is cash flow first, and then profit, and then assets, and then the end point is becoming the bank. Okay, some people can skip ahead, which I'll cover next week. But this is to explain. So that when we start to invest, we start with cash flow. Anything before that is just making sure that you don't have any bad debt, or you minimize that bad debt, and you've got a good financial understanding, and then the fun starts. Okay, so this is what we mean by starting with cash flow. So the reason why it's the only place to start is we can buy our time back, and we can get time freedom and financial freedom. Okay, so we're starting cash flow because we can get there much, much quicker. And we don't want an ego game here. So if we'd have gone back to the 1990s and 2000s, in any networking events, the question would be, how many properties do you have? Because the buy-to-let was one of the only models there. Some of the more advanced strategies were only just them getting developed. But who cares? Who cares? That's an ego game, okay? It doesn't matter. We want to get freedom as quick as possible. So we want to start in cash flow, okay? Because this is going to allow us to be financially free quicker, okay? So this is the game to play. This is honestly the game. So a decent SA property or a decent HMO will give you $1,000 a month on average. Now, there's variables there, but let's just say £1,000 a month, okay? Quite often it could be a lot higher than that, but let's say $1,000 a month. So if your target is, say, $5,000 a month, you need 5 properties. Okay, it's doable. But if you were getting £250 a month from a buy-to-let, okay, so £200 a month, you need 5 times as many for your goal. Okay, so you need 25. So you're delaying your financial freedom massively there, okay? You're making it way harder for yourself than what it needs to be. So step number 1 in terms of investing is build your cash flow. Okay, so I own luxury holiday lets where the gross income, so it makes £100,000 gross income. I mean, the Manor House in Wales brings in £200,000 per annum. So even after your mortgage and your maintenance and utilities, there's huge profit there. Okay, so we don't need many of those to be financially free, guys, do we? Or a rent-to-rent, for example. You know, if you're self-managing a rent-to-rent, you can earn £1,000 a month. Okay, profit. And if it's being managed by a third party, maybe £700, £750 a month. But again, you don't need many. You might need 4 or 5 of those. And what happens is, guys, you'll get freedom quicker. Okay, so if you want to leave your work, you can. If you want to slow your business down or leave your business, you can. If you want to become a full-time investor, you can. Or any other reason you've got to supplement your income, you'll get there a lot quicker. So if you want to fuel travel for your family, or you want to family care, or so many amazing things, you can do it far quicker by nailing cash flow first. Okay, far quicker than slower assets like buy-to-let, which I'll cover later. Now, I've got a first-hand experience, guys. I've done it right, I've done it wrong. I've got joint venture partners and mentees who've done it right and wrong, so we know the best order. Okay, so just to touch on that, for example, one of my joint venture partners, they were doing it, say, like the old-fashioned way. Nothing wrong with it, just very, very slow. So they were buying one buy-to-let property every year, or sometimes every 2 years. Once they're through capital growth, they were able to get the next deposit. And then we came along. And they invested in one of our holiday lets, and that holiday let, just their share of it, paid the equivalent, and this was their calculations, of 9 of their buy-to-lets. 9 of their buy-to-lets. How crazy is that? And again, I've had mentees in our masterclass where they've done buy-to-let for 20 years, and then they've learned more in a week of our masterclass than what they've had 20 years of investing. They've said they're getting more cash flow from one property than what they've done their previous portfolio. So just don't make it hard for ourselves, guys. And hopefully you're hearing this at the start of your journey, because then you're going to start off how you should. So build your cash flow. It's the only place to start. Okay. And then what do we want to do afterwards? Well, then we can go and make big capital. So number 3 is making big capital. So that's balance sheet, big profit. Okay. Lumpy money. Okay. Now within property investment, 2 of the more common ways of doing that are flips and deal packaging, deal sourcing. But it's best doing these later on. Okay. So sort your financial understanding out first, then nail your cash flow. Okay. and then move into something like building your capital up through deal sourcing and flips. Why? Why is the question I'd be asking now. Why do this later? Well, some really, really big reasons. So number one is we can't pay the bills on lumpy deal sourcing or flips. Okay, that's not financial freedom. You can't pay your mortgage or your lifestyle out of that because it's too feast or famine. Okay, we don't know when deal sourcing fees will come in. We don't know when flips will come in or the conveyancing. We can't control that. So we want to nail our cash flow first, get our lifestyle bills paid for. But there's other strategic reasons why I want to do this later on as well. Okay, so from an ethical perspective, let's just talk about deal sourcing for a second. So I am a deal sourcer. I do this now for other investors. So it's something that I can speak about, and I feel very strongly about this. I know this world, okay? Having worked with deal sources over the past 5 years, I don't like the model how it is right now, whereby a lot of newbies go into deal sourcing as a way of making some money. But there's so many bad deals out there, but many because they don't know what they're doing, okay? And we want to do it later on. Okay, so if you're thinking about becoming a deal sourcer, okay, then do it later on, once you've built your own portfolio. Because once you've built your portfolio in your principal strategy, you've made the mistakes, you've had the lessons, and you can look after your investors very, very ethically and create these amazing partnerships and win-wins, okay? And it's a beautiful place to be. But you don't want to be doing that needing the money, because if you need the money, either you'll do unethical deals that aren't that good, because you're trying to pay your bills and you'll be trying to package those up. No. But also, we don't know what we don't know. So it's better building our own portfolio first, okay? And if you have less capital, do something like rent to rent. And if you've got capital, start buying, build your own portfolio. And then if you want to do deal sourcing and packaging, then do that later on. Because when you don't need the money, you end up having a far higher bar. And then you can look after your investors very, very ethically. Okay, and it's the right place to be. And you'll have more experience. You'll have more contacts, relationships, network. You'll know what's what. You'll know what a good deal is, what a bad deal is, the best areas. And then you can build capital that way. And this is the same for flips as well. It's better doing it later on when we've got experience. Okay, so all right, if you're a builder, then you've already got experience. But if you're not, if you're quote unquote a normal investor, then we want to get our cash flow first. And then you can move into something like flips. Because again, flips or feast or famine. You know, you can't pay your mortgage on flip income. Bloody hell. Imagine the stress. If you're waiting to sell a flip and you've got to pay your mortgage in it and it's taken a while in conveyancing. No. Get a cash flow sorted first and then move into something like making big chunks of capital. Okay. And also then you've got more experience and contacts and network and builders and team around you to then go into the riskiest strategies like that. So it's a smart place to be. So this is honestly an incredible game plan to follow. Okay, and I'll talk about it from my world, from my experience, which I hope has real rich value for you. So I follow this model and I've built a large SA and holder portfolio, my lifestyle covered, my financially free, time free, location free, amazing. But now I've got a new devil to master, and I've got this charity to set up. I'm really, really passionate about it, and it's going to take capital. So I'm currently in the process of doing 2 flips, and I'm going to do some more flips moving forward. Okay, but I can do that now because I've built my cash flow and I've systemized the business and it's hands off, and also because I don't need the money. I don't need the money to live on. So it means that I can only do very, very, very good deals with a team I've got around me that I've built over the past 5 years. So it puts me in a far stronger position. And it's the same when I do some bespoke sourcing for people where I grow their portfolios for them because I love it. When am I better doing that? 5 years ago, when I don't know what I'm talking about, I don't know deals, I don't know my area, and I need the money, or now when it's the opposite, because what I'm able to do is keep a really, really high bar. Okay, so if you're interested in moving into something like deal sourcing, which can be an amazing thing to do, very, very ethically, if you like finding deals and it suits you, do it later. Get your cash flow sorted, nail that, then move into that. Because I promise you this, you'll have better success, you'll have a better life, you'll get there quicker and easier, you'll build better relationships, you look after people like family. It's a beautiful place to be. Okay, yeah, it really, really is. Okay, so this is the order. nail your financial understanding first. Okay, we need to be financially astute, great credit report, no expensive debt, no bad debt, plenty of good debt. Then build your cash flow. Spend as long as you need on building your cash flow. Systemize that. And then if you want to move into making big chunks of money, you absolutely can do, either to fuel a mission or just because you want to build up a war chest for a future recession, no problem. Just do it later. Do flips and deal sourcing later. Once you know your area and you know your deals and you know what's good and you've got a build team around you, it's far more ethical and you'll do far better. And then number 4, the fourth step on this game plan of becoming the bank, if you want to buy slower assets, things like buy-to-lets and commercial units, do this then. So if you've built up a war chest through flips and deal sourcing and you've already got your cash flow sorted, then do this way later to diversify. And you can diversify into asset classes here. So this might be where you go into very slow assets. You might put some money into the stock market, for example. Yeah, you might put some money into a commercial unit, into a buy-to-let. You might expect to get 6% net return on that money. Okay, but it'll be low risk, low return, low work. Okay, and you're doing it for the capital growth, or you're doing it for the hands-off nature, you're doing it for compound growth. Okay, but we do it later. Why? Because my lord, imagine how long that would take you if you started there. So again, yeah, as mentioned, like we mentor people, and people have come on the course and they've had buy-to-lets for 25 years, and they've not got the cash flow very quickly compared to what if it's just do it this way. They've delayed their retirement by decades. I'm financially free at 35 years old. If I'd have started at 20, it would have been 25. If I'd have started at 15, well, who knows? But yeah, then we can only start when we start, so we don't compare ourselves to anyone else. People listening to this a lot younger and a lot older than me. You do you. Comparison is a thief of joy. Okay, I'm going off into a tangent now. I do apologize. So do slower assets later, number 4. And then if you'd like to, number 5, you can become a bank. And this is a beautiful place to be. I've got investors of mine and joint venture partners of mine which are seen as a bank, and it's amazing. Okay, so once you've got in this position, so let's say you've taken the steps and you've become financially astute, you've built your cash flow business, then you've grown your capital base. Okay, then you diversified somewhat to reduce your risk. Then you're in a position where you can, a bit like a bank would do. Okay, you can securely lend your funds. Okay, and get a very good return for that, and it's completely passive for you. So someone else is doing all the work, someone else is finding the deal and doing the refurb. And there's many ways you can do this, okay? You can do this via a joint venture basis, joint venture partnership. You can do this on a loan basis once you've got enough knowledge and capital to do so. And you can live your dream lifestyle off the interest. Okay, so you can travel the world and make family memories either off the interest or the dividend if it's a joint venture. So you become the bank. Okay, so no work involved there, but from signing some forms and sending some money over. Okay, and then obviously you've got compound growth. So if you're doing this, if you're joint venturing in terms of buying properties with others, you're putting the money and they're doing the work, then obviously you're getting the capital growth and the income from that. Amazing. Okay, but if you're doing it on a loan basis, then you're getting the interest from that, and it compounds. So if you put £100,000 in and you're getting 10% return, you get 110 back. Then you compound your 110, you get to 122. So every year you're compounding your wealth. Okay, now naturally there's a right and wrong way of doing that. There's a secure and unsecure, ethical and unethical, right, you name it. You know, and I'm more than happy to do a deep dive into financing on a later podcast. But today's about the notion and the model of becoming the bank. Okay, and to recap, this is the order to do it in. Okay, so we want to nail our financial understanding first, remove any bad debt. Okay, become financially astute, get good debt. Okay, then as soon as we've done that, and hopefully most of you will be in this position, start with cash flow. Build your cash flow business first. Be far quicker, far easier, far less headache. Months and years rather than decades, guys. Okay? Huge. That tip alone can save you decades. Okay? Really can. So I hope it's understood. properly because I'm looking to reduce overwhelm in this sector, then you can make great capital, okay, very ethically, okay, in a partnership basis with flips or deal sourcing or other forms of making capital. Okay, then you can diversify into slower asset bases, stocks, shares, buy-to-lets, commercials, no problem with them, but do it later on from a position of cash flow sorted and capital. And then you can become the bank. Now, some people will already be on further stages. So some people, you might already be at number 5. Okay, you might already have ticked all those boxes over your life and you can become the bank right away. Okay, brilliant. Absolutely brilliant. Nothing wrong with that whatsoever. Okay, but there'll be others that are stage number 1. Okay, where you need to get rid of bad debt and you need to get grow your financial understanding. And a lot of people will be starting at number 2, whereby you've got a decent financial understanding, but you've got to get your investments off the ground. So you want to start with cash flow, or some of you might have done it in the wrong order, and that's okay. It really is okay. Because once you've got the knowledge, then implement it. Okay? So I hope that model's been really useful. Now, in terms of what we've touched upon here is different ways we can get going in the best order. So next week, I'm going to deep dive and cover a question I'm asked a lot, which is, do I need to go full-time into property investment? Okay, more importantly, do you need to go full-time into property investment or not? Okay, so that'll be next week's podcast. Okay, so I hope today's has been really valuable, becoming the bank model for you. And next week is, do you need to go full-time into property investment? Okay, so I'm looking forward to the next episode. Have a great week. I'll see you then, and take care. Thank you for listening to the Lifestyle Property Podcast. If you've enjoyed this episode, I'd love it if you could leave us a review so we can reach and help more people. I'll also be giving one person who leaves a review a free family holiday to one of our luxury holiday lets. Thank you, and see you next time.